Welcome. I would like to thank, first of all, to my subscribers who have been suggesting that I add different ratios. And one of my subscribers has also suggested that I look at the business model as such and explain briefly what the company does and what are its weaknesses and strengths. So, from this video onwards, I'll be doing a very short analysis of the business model, and then I'll go on to looking at the ratios of this company to understand the health or overall health of the company and if we should invest in these companies. So, today I'm analyzing companies which are in paint sector. Now, overall, the paint market is segmented into organized and unorganized markets. And apart from that, these markets are also further divided into decorative and industrial markets. The decorative market is divided into emulsion and enamel paints, cement paints, primer and thinner and ancillary products, whereas the industrial market is mainly divided into general industrial paints, automotive coatings, powder coatings, OEM paints and others. Now, the major drivers of the paint markets are the changing customer needs, the growth of automobile and infrastructure sector, entry of various Indian and international brands, and easy availability of the financing options. Along with the growth factors, there are other challenges also like seasonal demand, competition from unorganized players, inventory management at the dealers level. Now, the demand for paint basically comes from two broad categories. One is the decorative market and the other is the industrial market. As a major segment, the decoratives include exterior wall paints, interior wall paints, wood finishes, enamel, and ancillary products such as primers, putties, etc. The decorative paints account for around 80% of the overall paint market in India. So, this is a big segment. Asian Paints is the market leader in this segment. The demand for decorative paints basically arises from households painting their house, architectural and other display purposes, and demand in the festive season, which is basically between September and December, is significant as compared to other quarters. This segment is very price sensitive and is a higher margin business as compared to the industrial segment. Next, the demand for paint also comes from industries. And the three main segments of industrial sectors are automotive coatings, powder coatings, and protective coatings. Kansai Nerolac is the market leader in this segment. User industries for industrial paints include automobile engineering and consumer durables. Industrial paint segment is far more technology intensive than the decorative segment. Now, the paint sector is a very raw material intensive, that is, with over 300 raw materials required to manufacture paint, and 50% of that is petro based derivatives, which is involved in the manufacturing process. Since most of these raw materials are petroleum based, the industry benefits from the softening or reduction in price of the crude. Rupee volatility also contributes to uncertainty on the cost front and continues to create challenges for the industry. Many of these industries do export paints. Now, the key points or highlights are the supply and demand. The supply is generally exceeding the demand in both the decorative as well as the industrial paint segments. And industry as such is also very fragmented. The demand for decorative paints, of course, depends on the housing sector and good monsoons. And the industrial paint demand is linked to user industries like the auto engineering and consumer durables. Now, the bargaining power of suppliers is basically very limited. That is, the price increases are constrained with the presence of the unorganized sectors for the decorative segments, whereas the sophisticated buyers of industrial paints also limit the bargaining power of suppliers. It is therefore the margins are much better in the decorative segment. And the bargaining power of customers as such is high because of availability of wide choices. The data that I have just presented has been sourced from Equity Master's website. So now let us begin looking at the ratios of this company to understand the overall health as to how these companies are comparing against each other. Okay, so in today's video, we are analyzing paint companies like Asian, Berger, Kansai Nerolac, Akzo Noble, and Shalimar Paints. The results are up to date till June 2019. So let's begin our analysis by looking at the current market price and adjust the current market price with the face value of the share to get the adjusted price. Asian Paints current price is 1771. Its face value is 1. So after adjusting, that is multiplying the face value by 10 to adjust all of them to a value of 10, Asian Paint would be available at 17,000 rupees approximately. Berger Paint after adjustment with the face value will be available at 4,341. Kansai will be available at 5,100. Akzo Noble is at 2,000 rupees and Shalimar Paint is available at 430 rupees. Next, let us look at the latest market cap of these companies and compare it with where the market cap was 5 years and 3 years back. So that would help us understand the change of the market cap over the last 5 years. The current market cap of Asian Paints has increased to 1,69,869 crores. This is the price the company is available at in the market for all of the shares. Compared to that, 3 years or rather 5 years back, it was available at 77,000 crores. So the overall entire market cap has changed to almost twice. 3 years back, it was available at 1,02,000. So we can see a progress from 5 years back to 3 years back to the latest. The market cap has been consistently increasing. That is to say, even the prices have been continuously increasing from 5 years back. So this is a good sign. We want the market cap to be continuously increasing, which then indicates that the price is increasing, because market cap is nothing but the total price of the company in the market divided by number of shares, that is the price per share. Berger Paint market cap has also increased from 14,400 crores 5 years back to 23,000 3 years back and 42,000 in the latest year. Kansai Nerolac also has seen a growth in its market cap from 11,600 crores 5 years back to 27,000 currently. Akzo Noble's market cap has increased from 6,500 crores to 9,000. And Shalimar's market cap has increased from 267 crores to 467 crores. So all of these companies' market cap as such have grown from 5 years back as well as 3 years back. Next, let us look at what is the percentage fall in price from where the price was 1 year back. So this will help us understand where the current price is compared to where it was 1 year back. Asian Paints current price indicated in orange is 1,771 per share, and it has fallen 3% from where it was 1 year back at 1820. So it has fallen, or it is very nearby to its 52 weeks high. Berger Paint is fallen just 1%. Kansai Nerolac has fallen 5%. Akzo Noble has fallen 4%. And Shalimar's fall is at 12%. The highest fall seen was for Shalimar from 98 rupees to 86. But all of these falls are very nominal and it shows strength in the company. Next, let us look at the change in price over 1 year, 5 years, and 3 years. This would help us understand the movement of price over a period of time. Asian Paints current price has fallen 3% below its 52 weeks price, but it has increased by 118%, or almost twice of where it was 5 years back. And it has increased by just 65% from where it was 3 years back. So this would then help us understand the movement of the price. Now when the price has just moved 65% from where it was 3 years back, so basically it has moved just 20% approximately every year over the past 3 years, and around 23% over a period of 5 years. So then that would help us understand that the price has been generally moving on an average at the rate of somewhere around 20 to 23 or 25% every year. So that would be a very good indicator, or basically we can assume that the price would be moving by around 25% every year for Asian Paints. So this is just an estimate using the growth of price from where it was 5 and 3 years back. Berger Paint has or is very near to where it was 52 weeks back. So this is a very good sign. And it has increased by again twice from where it was 5 years back, and 80% from where it was 3 years back. So this is also good. The price again here too, Berger Paints has been moving at around, say around 20, again same range as Asian Paints. Kansai Nerolac has fallen 5% from where it was 52 weeks back, but has increased around 130%, or 1.3 times from where it was 5 years back. Again, a very good range to buy. But if we look at 3 years, from 3 years back, it has increased by just 35%. So we are getting it at a much lower growth rate of price compared to Berger and Asian Paints. Akzo Noble has fallen 4% from where it was 1 year back, increased by 38% from where it was 5 years back, and increased by just 1% from where it was 3 years back. So Akzo Noble's price as such is very near to where it was 3 years back. So we are getting it at a price which was 3 years back. So which is very good. But of course we have to also look at other ratios. Shalimar Paints has fallen 12% as we saw earlier from where it was 1 year back, but has increased by 75% and 49% both for 5 and 3 years. So this too is available at a reasonable growth of price. Here, when we are projecting the price growth, we don't want to buy into a company shares if the growth or the movement of the price is very high. Asian Paint price was 1700 and it was earning 23 rupees for every share as profit. That was just 1.3% return on the price paid for that share. Berger Paints was available at 434 rupees and earning just 5 rupee 50 paise. Again a yield of 1.3%. Kansai's yield was 1.7%, Akzo Noble's was 2.5%, and Shalimar's price was 86 rupees but had made a loss of 18 rupees per share in 2019. That's a negative earnings yield of 21%. That is a loss. So here we should make sure that our companies are earning high yield of at least above 6 to 7%, which is the fixed deposit risk-free rate. Next, let us look at how many times more we are paying for the earnings per share of the latest year. That is, how far away the price is compared to the earnings of the company. So the price was 1700 and the earnings were just 23 rupees. That is, we are paying 75 times more for the earnings of the latest 12 months to buy into the company. So which is very high. We should not, at least I don't pay more than 25 times the earnings per share. Berger Paints, again, price to earnings was very high at 78 times. In fact, all of these four companies are trading at an extremely high price earning multiple. So we have to understand, as we go down and look at other ratios, we'll understand why they are trading at such high multiples. Kansai was available at 58 times its earnings. Akzo was available at 40 times. Shalimar Paint had a loss, therefore the price earning is not calculated. Next, let us look at the 5 years average price earning and the last 3 years average price earning, and then compare that with the current price earning. So we can understand then whether the price earning of the latest 12 months, even if it's high, how it was during the last 5 and 3 years. Asian Paints current price earning is 75 times, and in the 5 years or last 5 years on average, the price was quoting at around 54 times its earnings, and in the recent 3 years it was quoting at 55 times. So of course, if the averages were around 50 less than 55 times and the current price earning is 75, it shows that it is expensive and we can wait for price earning to come to around 55 to buy into the company. Berger Paints, we should expect the price earning to be somewhere again at around 50 times, because that is what is the average of the last 5 and 3 years. Kansai also has to come down to around less than 40% to buy into the company. Akzo Noble also has to fall to around 30% price earning, or 30 times price earning to buy into the company. Shalimar Paint, since the latest price earning is not available, but it is still quoting over a period of last 5 and 3 years at around 39.8 times. So this gives us a very good idea as to, even if the price earning is very high, where we should buy into these high value companies. Next, let us look at the earnings these companies have generated and how much of these earnings has actually been received in cash, and out of this cash, how much was used to buy assets and how much was left as free cash to be used in the financing activity. These are the per share based values. Asian Paints profit per share, as we saw earlier too, was around 23 rupees per share, and it received cash of 23.1 or 10 paise per share in 2019. So most of the profit the company has shown has got converted into cash, and out of this cash the company still has almost 50% left over as free cash. That is, out of this 23 rupees, 11 rupees is still there with the company to be used in financing activity, and the balance is used in buying assets. Berger Paint profits per share were 5 rupee 50 paise, and the cash coming in was 5 rupee 80 paise. So this is also good, and almost half of it is still left over as free cash. Kansai's earnings were 8 rupee 80 paise per share, and the cash coming in was just 2 rupees. So that is almost 1/4. I want that whatever company is shown as profit or net profit or earnings has to get converted into cash. And out of this cash, the company's free cash is negative, that is, it has used up this entire 2 rupee of cash earned from operations into buying of assets. Over and above that, it has utilized 7 rupees 70 paise to buy more assets. So if the company is in a growth, a high growth, then this is justified. Otherwise, it does not make sense putting more and more money into assets if the company is not growing. So when we look at the growth metrics later on, we'll understand whether more investment in the assets is justified. Akzo's profits or earnings in 2019 were 49 rupees. Out of the 31 rupees was received in cash. That is a shortfall, and 21 rupees was left over as free cash out of that 31. So this is good, but the amount of cash the company has received is way too less compared to the profit it has shown. So we have to investigate why the company, if we want to invest, then why the company has received less cash compared to the profits declared. Shalimar's case is very different. It has made a loss in 2019 of 18 rupees per share. It has not received anything in cash. In fact, there's a cash outflow of 17 rupees. And it has still invested 23 rupees additional cash into buying assets. So if the company is making losses, why is it investing more and more into buying assets? So let us understand that as we go down and look at other ratios. These are all valuation ratios that we are analyzing right now to understand if we can buy or where the current price is compared to different variables. Here, let us look at how many times more we are paying for the cash generated from operations of the latest year. We are taking the entire value of the market cap as well as operating cash generated through the business operations. Asian Paints, the entire company was available at 1.69 lakh crores, and the cash generated was just 2,200 crores. That is, the price to OCF is very high at 76 times, even higher than the price to earnings. So here too, I don't want to buy more than 25 times. I don't have the projection of where the price to OCF was of the 5 and 3 years. Therefore, we cannot clearly compare the price to OCF of the current year against its averages. Berger Paint's entire market cap was 42,157 CR, against which it earned a cash of 562 CR in 2019. That's a 75.1 times multiple. Kansai's price to OCF multiple was 249 times. So although the market cap was 27,000 crores, it just earned 110 crores against that in 2019. That's a 249 times multiple. Akzo Noble's multiple was 64.1 times, again very expensive. Shalimar's operating cash flow was negative, meaning the cash from operations was negative. No cash came in against the profit shown by the company, and the market cap was 467 crores. So that's a negative multiple. We don't want to see a negative multiple. I would like to buy my companies when the entire market cap to the cash generated is around 25 times. That is, the market cap is 25 times more, max 25 times more than the operating cash flow. Next, let us look at the entire market cap and the free cash flow. Where the market cap was, or how many times away the market cap was against the free cash the company has. Asian Paint's entire market cap, as we saw earlier, was 1,69,000 crores, against which it had a free cash of 1,081 crores in 2019. That's a 157 times multiple. Berger's multiple was 172 times. Kansai's multiple was negative 66. That is, the company didn't have any free cash to be used in the financing activity. Rather, it has spent an additional 413 crores of cash on buying of assets in 2019. Akzo Noble's multiple was 91 times. Against the entire market cap of 9,000 crores, the company's free cash was just 99 crores. Shalimar Paint's multiple was negative. Again, the company didn't have any free cash. In fact, it has spent an additional 128 crores on buying of assets against the cash it had earned in 2019 through operations. So here too, I don't want to pay more than 25 times more than the company's free cash holding of 2019. Next valuation ratio is the price to book value. This is the per share analysis. Asian Paints per share was available at 1,771 rupees, against which the company's actual shares value was 99 rupees. This is the value of the share as per the company's records. Now the way to calculate the book value is you sell off all assets of the company and you pay all liabilities, whatever liabilities the company has, and after paying all liabilities, the amount that remains with the company is the net worth or the money which is to be distributed to the shareholders. And as per that, each shareholder in that case would get just 99 rupees. That's the actual value of the share, or that's the value the shareholders would get when the company is liquidated or closed. Against that, the current price of the share is 1,771 rupees, which is a 17.8 times multiple. This is a very high multiple because as per my benchmark, I would not buy a share more than 2.5 times its book value. That is, I don't want to pay 2.5 times more than what the share is actually worth in case of liquidation. Berger Paint's multiple was also very high at 17.1 times. In fact, all of these companies' multiples were very high. Kansai was available at 8 times its book value. Akzo Noble was also available at 8 times its book value. And Shalimar was available at 1.6 times, the lowest available. Now, why is Shalimar Paint available at such a low multiple to its book value compared to its peer group needs to be understood. And as we check out different ratios going ahead, we'll understand why it is trading at such a low price to book multiple. Next, let us look at the valuation ratio current market price to the sales. Here, instead of taking the current market price, I'm taking the current market cap. That is the entire market value of the company and comparing it against the sales the company has done in 2019. Asian Paints current market cap is 1,69,000 crores. This is the company's value in the market as of 2019, against which the company has managed a sales of 20,000 crores. This is the revenue it generated in 2019, which is an 8.5 time multiple, which means that the company's market cap is 8 times more than its sales. Generally, I would want to buy into a company where the market cap is very near to the sales. That would basically guide me or tell me that I'm not paying a very high multiple against the sales that is being generated by these companies. That is, I want the multiple to be as near to 1 as possible. Berger Paint's multiple is also very high at 6.7 times. The entire market cap was 42,000, against which it generated a sales of 6,200 crores. Kansai's multiple was 5.2 times. Akzo's multiple was 3.1 times. On a market cap of 9,000 crores, it managed to generate a sales of 2,900 crores. Shalimar Paint, on a market cap of 467 crores, it has managed to generate a sales of 321 crores, which is 1.5 time multiples, the lowest in the group. Now, valuation wise, Shalimar Paint is the most reasonable or most economical, but then are other ratios matching up to that low valuation? Low valuation does not mean a buy, and a high valuation also does not mean it's a buy. It's just that we need to buy at a low valuation along with all fundamental ratios being intact. Next, let us look at the product of price earning and price book. This is the Benjamin Graham's formula, which says that a conservative investor should not pay more than 22.5 times the product of price earning and price book. That is, the max price earning or maximum price earning an investor should pay for a company is 15 times, and for the price book it should not exceed 1.5 times. Asian Paints product of price earning and price book was 1,300, which is very high. Both the price earning and the price book are at a very high valuation. Similar is the case for Berger Paints, Kansai, Akzo, and Shalimar is not available because we don't have the price earning, because the company had loss in 2019. Next, let us look at the profit growth compounded over 5 years and growth in profit compounded over 3 years. That is, how has the profit been growing from 5 years back till date. Asian Paints has managed to grow its profits over a period of 5 years at the rate of 12.1%. My benchmark for the growth rate in profit is 10% and above. But in the recent 3 years, Asian Paints has seen a drop in its growth rate to 7.5%. Berger Paints has managed to grow at 14.5% in 5 years and 10.9% during the last 3 years. So it is still above the benchmark. Kansai's growth rate in profit was 17.2%, but in the recent 3 years, a profit was seen below where the profit was 3 years back. So there's a degrowth in profit from 3 years back by 1.4%. We want the profits to be growing from both where it was 5 years back and where it was 3 years back. To put an example here, if the profit 5 years back was 100 and 3 years back it was 120, today we would want it to be more than both 100 and 120. Here in case of Kansai's, what has happened is from 3 years back, if for example if it was 120, the profit was 120, then the profit has today's profit has fallen even below 120. So that is what is showing the degrowth in profit. Akzo's profit over a period of 5 years at least has grown at 14%, but in the recent 3 years it has slowed down to 1.7%. So what we are looking for in this particular case is that the 5 years growth rate should be above 10%, but the 3 years growth rate should be even little faster than how it was growing during the 5 years. So that shows that the company is managing to grow its profit much faster during the 3-year period compared to the 5 years period. Shalimar Paint's data for both the 5 and the 3 years growth rates are not available because the company has been making losses from both 5 years and 3 years back. So let us look at the P&L account of Shalimar Paint through screener.in. If we look at the P&L account of Shalimar Paints in March 2019, it made a loss of 82 crores. 3 years back, it made a profit of 5 crores, and from there, it has made a loss of 82 crores. So the growth rate cannot be calculated. And if we go back to 5 years, it made a loss of 3 crores and now a loss of 82 crores. So that too is not calculable. We cannot calculate when the growth rates are not same. Next, let us look at the price earning to profit growth rate ratio, that is the PEG ratio. The growth rate in this case we are considering is the 5 years of profit growth rate we saw earlier, and the price earning is of the latest 12 months. So basically what we are trying to understand here is that if we are paying a certain price for the earnings of the company, is that justified? And the way to understand is by looking at the growth in that earnings over the last 5 years and projecting that growth rate over the future 5 years. To make it more clear, let us look at the Asian Paints. We are paying 75 times the earnings of the company, and we are getting a growth in that earnings of around 12%. That's a PEG of 6.2. Now, if we are paying such a high multiple for the earnings of the company, and if the earnings is growing just at 12%, then basically we are paying a very high price. Now the way to calculate PEG is by dividing price earning with the profit growth rate of 5 years. I want the PEG to be below 1.5 times. When the PEG is around 1.5 or below 1.5, it suggests that the price earning multiple we are paying for the company is justified. Berger Paint's PEG is also very high at 5.4. Kansai's PEG is 3.4 and Akzo's is 2.8. Shalimar Paints we don't have the multiple because we don't have the price earning data nor the profit growth rate of the 5 years. Next, let us look at the price earning of the 12 months and compare it with the growth rate in profits or earnings over the period of 3 years. This is similar to the PEG ratio we saw for the 5 years. Only thing here is we are using the 3 years profit growth rate to understand if in the recent 3 years is the PEG become better. Next, let us look at the price earning to profit growth rate of the 3 years. Here too we would want to understand if you are paying a certain price earning multiple for a company's shares, then against that earnings that we are paying for, how is that earnings growing? So that is very important to understand. Asian Paints PEG is 10, which shows that even though we are paying 75 times, we are not getting the growth in that earnings. Berger Paints earnings are growing at 10% and we are paying 78 times that earnings. So the PEG works out to 7.2. As I mentioned earlier too, we want the price earning to profit growth rate to be below 1.5. Kansai's price earning multiple is 58 times and the profit had a degrowth of 1.4%. So it's gone into negative. So therefore the PEG also goes into negative. The thing here is, why would we want to pay 58 times the earnings if the earnings doesn't have growth? Akzo Noble had a growth of 1.7%, although we are paying 40 times the earnings. So that too is not good. Shalimar Paints, neither do we have the latest price earning because there was a loss. Next, let us look at the growth in sales over the 5 and 3 years period compounded. That is how the sales has been growing from 2014 onwards and 2016 onwards. That is the 5 years period and the 3 years period. Asian Paint sales has been growing at 9.6% since last 5 years. So that's a good growth rate, although I would want it to be above 10% at least year on year. And in the recent 3 years, the sales has been growing at 10.7% compounded. So these are good growth rates. Berger Paints and Kansai too had about 10% of growth rate in their sales. Akzo Noble had a very low sales growth of 4.6% and 3.4% for both 5 and 3 years period. Shalimar Paints in turn has seen a negative growth rate from both 5 and 3 years back at 9.2%. So that is why we see that valuation wise it is available at a very low multiple compared to the peer group. Because the sales has been falling continuously, we saw the profit also had a quite a degrowth in them. Next, let us look at the return ratios. That is, what is the net profit the company has generated on shareholders' equity over the past 5 years and the latest year. Here we are trying to understand what is the net profit these companies have generated on the total equity plus additional reserves and surpluses that the company has. So first we'll understand what is the 5 years average ROE and then compare it against the latest ROE of 2019. Asian Paints 5 years return on equity was 27.2% on average, which is a good ROE. Anything above 15% is good. Even in latest year, although below average, it is around 24% return on equity. Whenever a company earns a good return on the shareholders' money, the shareholders generally give it a premium, and that is also understood because that is the whole point of investing in a company, that it should generate a good return. Berger Paints too has generated a return of above 20% for both 5 years and 2019. Kansai's 5 years average is 17.2% return on shareholders' money, but in the recent 2019, the ROE has fallen below 15%. Akzo's 5 years average is good at 20%, but in the recent 2019, it has seen a fall to 16%. Shalimar has been making losses since last 5 years on average at 21%, and in the recent 3 years the losses have increased to 32%. So if we see here, in 2019 the loss was 82 crores, in 2018 the loss was 45, in 17 it was 10 crores. So it has been consistently making losses over a period of 5 years. Why would we want to invest in a company which has been consistently performing poorly and making losses over the 5 and 3 years period? We can also use a benchmark average of all of these 5 companies for both the 5 years period and 2019 and use that as the benchmark. So anything above that benchmark is also or would be considered a good value. Next, let us look at the return on assets or ROA of the last 5 years on average and what was the ROA in 2019. In this case, the assets are basically the fixed assets of the company plus the working capital. Again, working capital is made up of current assets minus current liabilities. Current assets are those assets which we have to sell off in the current year, and current liabilities are those liabilities which we have to pay in the current year. So basically we are taking the fixed assets plus the working capital and looking at how much EBIT was generated on it, or basically operating profit was generated on the fixed assets plus working capital. So this is the return on assets. Asian Paints ROA of the last 5 years on average was 39.3%, which is very good. So basically on whatever assets the company has employed into the business, on that it is generating almost 40% over the last 5 years on average. In 2019, the percentage return was 35. Berger Paints managed around 28.6% throughout the 5 years, and in 2019 it was around 28.2%. So again, very good. Even Kansai Nerolac and Akzo Noble had about 20% of returns on total assets. Shalimar's since had lost since last 5 years on average, the return on assets was also negative, and in 2019 it was 18% negative. Here too we would want it to be above 15% at least. Next, let us look at what is the return generated on the capital employed or ROCE ratio over the 5 years on average, as well as in 2019. This would help us understand how efficiently the company has generated net profits on the total source of funds. Asian Paints ROCE over the last 5 years was 24%, and in 2019 it was 21.4%. So this is good. Again, anything above 15% should be considered good. Berger Paints, Kansai Nerolac over the period of 5 years, in fact Akzo Noble too, over the period of 5 years have generated above 15% of returns. Berger Paint in 2019 and Akzo in 2019 have generated above 15% return. Kansai's ROCE has fallen below 15%, and since Shalimar had a loss over the period of 5 years, its returns were negative, and in 2019 it was 17.4% loss on the total investments or total sources of funds. Next, let us look at how much sales was generated on the capital employed by the business. Here too, capital employed is the total source of funds of the company in 2019, and on that, what was the sales generated in 2019. Asian Paints total capital employed by the business was 10,147 crores. On that, it has generated a sales of 19,000 crores. That's around 1.9 times more than the capital employed. So we want to see a figure like this, where the sales on the total capital employed is more than what was employed into the business. Berger Paints too had a multiple of 2 times. Kansai's multiple was 1.5 and Akzo's was 2.6. Shalimar Paints has seen a below average sales than what was employed as capital. So the capital employed was around 441 crores. On that, it managed a sales of just 288 crores. So this is not good. We want the ratio to be at least 1 or above 1. That is, the sales should be at least equal to the capital employed or more than the capital employed by the business. That shows efficiency of the business in generating more sales on what was employed into the business as capital. Next, let us look at how the company has managed to convert its net profit into cash. Asian Paints total net profit shown over the last 5 years was 9,200 crores, against which the company has received 9,286 crores. So that is almost equal to the profit. That is, whatever profit the company has shown has actually been received in cash by the company. So this is a good conversion rate of net profit into cash. Berger Paints has shown a profit of 1,900 crores and has received 2,300 crores against the net profit. Now, to understand why the cash coming in is more than the net profit, you will have to understand the cash flow statement. In the cash flow statement, whatever cash inflows and outflows are happening into the business, and only cash, those are recorded, and the non-cash transactions are excluded. So when we calculate the P&L account, we have to add depreciation as an expense. Although depreciation is an expense, nothing is going out of the company. No cash as such is going out of the company. Any write-offs, bad debts, these are non-cash expenses, meaning no cash has been going out of the business for those expenses. Therefore, when we calculate the cash from operations, we have to add back those expenses which have not been actually spent or went out of the business. Therefore, the cash could be more than the profit, or it can even be less than the profit. But here we would want to see companies generating more cash than the profit shown by it. Kansai's cash was 29% short of the total profit shown, whereas Berger's cash was 20% more than the profit shown. So we would want the cash component to be more than the profit. Akzo's cash also fell short by 21% against the profit shown by the company. Shalimar's last 5 years was making a loss of 127 crores in total, against which the company had a cash inflows of around 48 crores. Since we cannot calculate the change from the negative value to the positive, we don't have the score here. As I mentioned earlier, we would want the cash component to be more than the net profit shown by the company. Next, let us look at how this cash has been used in investing and financing activity. That is, whatever cash the company has shown as its inflows into the business through operations, of that how much it has used to buy assets and how much it will use in financing activity like paying dividend, doing buyback bonus, or doing repayment of loans, etc. Asian Paint's total cash inflows over the last 5 years was 9,286 crores. Of that, it still has 4,836 left over as free cash, and 48% of this cash of 9,200 was used in buying assets. So this is a good way a company can grow. We don't want the company to be investing more cash than it is generating from operations into buying of assets. So there has to be a balance between how much it is putting or how much it is using to buy assets and how much it still has to use in the financing activity. Berger Paints also had a similar case of 48% investments in assets and the balance 1,200 left over as free out of the cash it generated over the last 5 years. Kansai also had a good investments of 46% in assets and 825 crores left over as free cash. Akzo's investments in assets was just 34% of the cash it generated over the last 5 years. Shalimar's free cash was negative. That is, out of the 48 crores of cash it earned over the last 5 years, it has invested all of that into buying of assets. Over and above that 48 crores of cash, it has invested additional 41 crores in buying of assets. So we don't want to see a company buying assets or growing at a pace of more than what it is earning in cash. So this is not good. Next, let us look at how the free cash has changed over the 5 and 3 years on an average basis. Asian Paint had generated 1,081 crores in 29 as cash, or rather free cash. Out of this, over a period of 3 years on average, it was generating 882 crores. So of course, in the recent 2019 year, it has generated more cash when compared to the last 3 years. Even when compared to the last 5 years, it has generated more cash. So this is good. So Asian Paint has generated cash above its both 5 and 3 years average. Berger too has generated almost more than its 3 years and 5 years average cash, free cash. Kansai's free cash in the latest year was negative 413 crores. Kansai Nerolac had a negative free cash, that is, the company's free cash was negative in 2019 by 413 crores. which means the company in 2019 has invested whatever cash it earned through operations into buying of assets. Over and above that, it has utilized 413 crores in buying of assets. And over a period of 3 years on average also, we see a 76 crores of free cash flow. That is, the company doesn't have anything to use in the in the financing activity. Whereas over a period of 5 years, it had a positive free cash of 165 crores. So this has worsened than where it was in last 5 years. Akzo's latest year free cash was 99 crores. On an average of the last 3 years, the company was generating free cash of 82 crores, which is above the average. Akzo Noble over the last 5 years was generating 117 crores. Therefore, the current cash or free cash was below its 5 years average but slightly above its 3 years average. So this is also okay. Shalimar Paint also had a negative free cash in 2019 of 128 crores and way below its 3 years and 5 years average of minus 27 crores and minus 8 crores. So overall in 5 years the company had no free cash on an average basis. So when we are looking at this ratio or this chart, we should see that the free cash as in Asian Paint and Berger Paint, where the free cash is more than its 5 and 3 years average. So we want more and more free cash to be generated by the company, as that would be or that can be utilized to pay dividends, bonus, buyback, or doing more acquisition. It shows again a very good efficiency as to how the management is handling the business. Next, let us look at the net profit of the last year and look at how much of that net profit was actually received in cash by the company. Asian Paint has received 3% more cash than the profit shown by the company in 2019. Berger Paint has shown 15% more cash coming in against the profit. Kansai Nerolac had a 76% of shortfall of the profit shown. The profit the company showed in 2019 was 452 crores, but the company managed to earn or receive only 110 of that 452 crores in cash. So this is not a good sign. As I mentioned earlier, for 5 years also, therefore in single year 2, as I mentioned earlier, in 5 years we want the cash to be generated more than the profit. Similarly, even in 1 year 2, we want more cash coming in against the profit shown by the company. Akzo Noble also had a shortfall of almost 27%, and Shalimar Paint in 2019 had a loss of 66 crores and cash outflow of 96 crores, meaning not only did the company not receive any cash, in fact it had a outgo of 96 crores from its operating activity. Again, not a good sign at all for Shalimar Paints. Next, let us look at what is the growth in net profit of the latest 12 months over its 5 years average net profit. Asian Paint's current year's profit of 2,255 crores is 22% more than its 5 years average of 1,850 crores. So this is good. Berger Paint's profit was 35% more than its 5 years average. Kansai's profit was also around 11% more than its 5 years average. Akzo Noble's current year's or 12 months profit was almost similar to where it was 5 years on average. Shalimar Paints has seen a 122% more fall over its last 5 years PAT. In fact, last 5 years it has been making losses of around 25 crores on average, and in 2019 it made or rather in the recent 12 months it made a loss of 56 crores, which is around 122% more than its 5 years average. So now we start understanding why Shalimar Paint's valuations are so low in the market and why it is available at such a low multiple compared to its peer group companies. Next, let's look at the profit after tax growth rate year on year, that is from 2017 to 2018. What was the growth in profit? Asian Paint has grown by 5% in net profit over its previous period. Berger Paint saw a 9% growth rate in its profit. Kansai Nerolac's profit fell by 8%, whereas Akzo Noble's latest 2019 profit of 195 crores was 50% less than where it was in 2018 at 384 crores. Shalimar Paint's current year loss was more than the previous year of 2018 by 45%. Next, let us look at the quarterly growth rate YOY in sales and profit. Here we are comparing June 2018 quarter with June 2019 quarter. Earlier we saw the 5-year growth rate. Previously we saw conversion of 5 years of profit into cash. We also saw how the profit of 2019 has grown over its 5 years average. Now we'll look at the very near term picture in terms of quarter on quarter analysis. Asian Paints sales, indicated in green, has grown by 17% and profit has grown by 18% over its previous year's June 2018 quarter. Berger Paint has grown 16% in sales and 32% in profit. Kansai has grown by 6% both in terms of sales and profit, which is below my benchmark of 10%. Akzo Noble's sales has grown by just 1%, but the profit has grown by 31%. So whenever any company's growth rate in profit or sales is more than 20%, we need to investigate why the company's profit has grown over its previous quarter by such a high margin. Is that because the previous quarter's profit had fallen in compared to its own previous year's or previous quarter's profit? So if the profit has fallen and in the current year the profit has increased, that will inflate the growth rate in profit. So we have to be careful as to what the base year's profit value or the sales figure was. Shalimar is showing 65% growth rate in both sales and profit. In June 2019, the company had a net loss of 5 crores, and in June 20 the company had a net loss of 15 crores. So although the loss has reduced, it is showing a positive growth rate in net profit, because from 15 crores the loss has reduced to 5 crores. So we have to be very careful when we see certain type of growth rates in profits and sales. Next, let us look at the net worth and contingent liability. Net worth is the actual value of the company or the value of the company as per its books, and contingent liability are those liabilities which the company may or may not have to pay in the future. Now the thing about contingent liability, or the thing that we have to understand about contingent liability, is that these liabilities are not shown in the balance sheet. Therefore we have to be careful that the company doesn't have a very high contingent liability, because these liabilities are hidden liabilities which may arise in the future. Now we don't want the contingent liability to exceed 20% of the net worth. Asian Paint's net worth was 9,520 crores, against which its contingent liability were 231 crores. That's a mere 2%. So this is good. Berger Paint's contingent liability as a percentage of net worth was 15%. So this is also good. Kansai's contingent liability was very low at 1%. Akzo and Shalimar's contingent liability have exceeded my benchmark of 20%. and they're approximately around 24% for each Akzo as well as Shalimar. Next, let us look at what is the source of funding for the company. Is it more through debt or equity? Or rather, we'll look at the debt to equity ratio and also look at what is the debt burden of this company. Asian Paint's total debt was 627 crores against its equity base of 9,520 crores. That's a ratio of just 0.1 times between debt and equity. So we don't want the debt to equity ratio to exceed 1 time, meaning the debt and the equity can be equal, but the debt portion should not be more than the equity. Berger Paint's debt to equity ratio was just 0.2 times, so this is also okay. Kansai Nerolac's debt was very less at 10 crores against its equity base of 3,424 crores. Akzo Noble's debt to equity was also very low at just 3 crores. Shalimar's debt to equity ratio was highest at 0.5. Its total debt was 152 crores, where its total equity base was just 289 crores. Also, this is okay because it's still below my benchmark. Next, let us look at the debt position of the company, where it was 3 years back compared to the latest debt position. Asian Paint's debt 3 years back was 323 crores, and that has increased by almost 50% to 627 crores. Berger Paint's debt also has increased from 354 to 520, although I've given it a positive value because the debt portion as such against the equity is very low. Kansai's debt has actually reduced from where it was 3 years back. Akzo's debt has remained stable at 3 crores. Shalimar's debt has also increased from 137 to 152 crores. Next, let us look at debt to profit ratio, in which we understand what is the debt of this company and can it pay off this debt using the net profit of the generated in 2019. Asian Paint's total profit generated was 2,150 crores in 2019, against which its total debt was just 627 crores, which we saw earlier. So the multiple is 0.3. That is, the company can very easily pay off this debt using just the current year's net profit. Berger Paint's ratio was at 1 times, meaning the profit earned was 490 crores in 2019, against which its debt stood at 520. So it can very easily pay off within 2 years or less than 2 years. Kansai's debt to profit ratio was also very good at 0 times, which means the company can very easily pay off this debt of 10 crores. Same goes for Akzo, where its debt was just 3 crores. Shalimar case was different. Its total debt is 152 crores and the company has made loss of 66 crores in 2019. So it will not be able to service this debt or pay off this debt until it comes back into profit. Next, let us look at the interest coverage ratio, which compares the EBIT to the interest paid. Here we are trying to understand how easily can the company pay off its interest obligation on the debt it has taken using the EBIT it is generating. EBIT stands for earnings before interest and tax. Asian Paint's EBIT was 3,353 crores, against which its interest cost was just 56 crores. That is a 42.8 times multiple, which means the EBIT was 42.8 times more than what it had to pay as interest cost. So this is very good. We want to buy into companies whose EBIT is at least 4 times more than what it is paying as interest cost. Since these companies have very low debt, their interest liability would also be very less. Berger also had a 20.6 times interest coverage. Kansai's interest coverage was very high at 577 times because it's a debt-free company. Same goes for Akzo Noble, but Shalimar Paint, since its EBIT was 68 crores of loss, that is earnings before interest and tax, was a loss of 68 crores. On that, it still had to pay 25 crores regardless. So that's a negative interest coverage. Next, let us look at the promoter holdings of these companies and how much, if any, of these promoter shares have been pledged. Now, when the promoter's stake in the business is high, they will have a high incentive to run the company well. And if the company has taken any loan on their pledged shares, we want to make sure that the pledged share does not exceed 20% of the promoter holding. Asian Paints promoters hold 53%, which is good. We want the promoter holding to be more than 30%. So all of these companies' promoter holding is very high. Compared to that, only Asian Paint promoters have pledged 12%. Rest, none of the companies' promoters have pledged any of their shares. Next, let us look at the raw material cost as a percentage of sales. Asian Paints, Berger Paints, Kansai and Akzo all had their raw material cost between 50 to 60% of their sales. So this is all okay. But if we look at Shalimar Paints, we see as a percentage of the total sales, the raw material cost was very high at 77%. So this is a red flag for us to look at. Why only Shalimar Paints total raw material cost is exceeding the average industry standard. Next, let us look at the debtors to sales ratio. This ratio helps us understand how much money is still pending to be collected from the customers or accounts receivable against the current year's sales. Asian Paints sales of 2019 were around 19,342 crores, of which only 1,900 is still to be collected from debtors till date. So this is very good. We don't want the debtors to exceed 30% of the current year's sales. Berger Paints, the debtors to be collected were just 10% from the current year's sales. Kansai's debtors were also around 12% and Akzo's were around 15%. So this is efficient. Companies don't have too much of accounts receivable pending to be collected. Shalimar Paints has seen slightly above 30% of debtors against the current year sales. In 2019, Shalimar Paints did a sales of 288 crores, against which it still had to collect 99 crores from its customers, which is around 30.8% of the current year's sales. Next, let us look at within how many days the company is collecting payment from its customers. Asian Paint has been collecting payment from its customers within 36 days. This is the credit period it is giving it to its customers. Whereas 3 years back it was collecting it within 30 days. So it has slightly increased. That is, the company is giving more credit days to its customers compared to where it was 3 years back. Berger Paints credit period to its customers have decreased to 40 days from 47. So this is also good. The lower the days, the better it is. That means the company is collecting payment from its customers much faster. Kansai's collection days have also decreased from 51 to 48. Akzo's days have increased from 49 to 56. Shalimar is taking the highest number of days from 136 3 years back to 126 in 2019. Not only is the total payment to be collected from customers high, but it's taking a very high number of days to collect that payment from its customers. For me, the benchmark is maximum 90 days of credit period to the customers. Anything above that would affect the working capital needs of the company. Next, let us look at the debtors versus the creditors. That is, how much payment the company has to collect from the debtors against how much it has to pay to its own suppliers. So if the company manages to work with suppliers' money, that is always good, because on that money, the company does not have to pay any interest. Asian Paints debtors were 1,900 crores, against which it had to pay 2,500 to its own suppliers. So the debtors to creditors ratio is 1.3 times, meaning creditors are more than the debtors. So this is good because the company is utilizing the creditors' money. Berger Paints also had a similar ratio of 1.3 times. Kansai had a equal ratio between debtors and creditors. Akzo Noble's ratio was 1.3 times and Shalimar's was 1 times. So all of these companies are mostly working with creditors' money. Next, let us look at the average OPM of the last 5 years and also look at the latest net profit margin and compare it with the net profit margin of the preceding year. We want the OPM on an average basis to be more than 15% and NPM to be around 10% or more. Asian Paints has managed an OPM of 18.5% or operating profit margin of 18.5% over a period of last 5 years on average, which is very good. Compared to that, the net profit margin is above 10% in 2019 as well as in 2018. Berger Paint OPM was below the benchmark at 14.7%, whereas NPM has also fallen below the benchmark of 10%. Even in previous year, the NPM was around 8.9%. Kansai's OPM is 15.7%, but in 2019 the NPM fell below 10%, whereas in 2018 it was 11.3%. Akzo's OPM was very less at 11.6%, therefore it also affected the NPM in 2019, although in 2018 its NPM was 14.7%. So there is almost a 50% fall in the NPM from 2018 to 2019. Shalimar's OPM over the last 5 years on average has been negative 2.5%. So this is already in our analysis. We have already excluded this company for the sake of the analysis and to understand different ratios. We'll continue analyzing Shalimar Paints. The OPM is negative 2.5%. The net loss margin in 2019 was 28.4%, whereas in 2017 also it had a negative profit margin of 16.8%. Next, let us look at the current ratio and the working capital requirements for these companies. Current ratio is basically current assets divided by current liabilities. That is how much the company has to pay in the current year against how much it can sell in the current year using its assets. So we are trying to understand the liquidity position of the company and can it service its current liabilities using the current assets. Asian Paints current assets were 6,544 crores, more than the liability it has to pay in the current year. So this is a good ratio. In fact, all company has a good liquidity position between current assets and current liabilities. Next, let us look at what is the size of the company's total assets before deducting depreciation and how much of this has already been depreciated to the P&L account in the past years. Asian Paints total gross block was 7,256 crores. This is the total assets on the company's book as of now because it has still not been completely depreciated. Of that 7,256 crores, 1,405 has already been depreciated. So the balance is the net block or net assets of the company. That is, the company has depreciated 19% in the past years to the P&L account. So here we want it to be more than 20 to 30% so that a major portion of that gross block has already been transferred to the P&L account, and in the future the pressure on the P&L account will be less if the company is not increasing its assets base. Berger Paints depreciation was 393 crores in all. That is just 22% of its total assets. Kansai total accumulated depreciation was 38%, which is a good value. Even Akzo Noble has managed to transfer 30% of its assets to P&L account in the past years. So it still has 70% of the assets to be depreciated to the P&L account. Shalimar Paint is depreciating its assets at a total 10%, which is very less. So out of the total assets of 241 crores, only 24 crores has been transferred to the P&L account, which is mere 10%, and very much below the averages of the 5 companies. Next, let us look at the net block, that is the size of the net assets of the company after removing accumulated depreciation from the gross block, and at what rate the company is depreciating its assets every year. So that would help us understand how much depreciation is going to get transferred to the P&L account every year and what kind of pressure it will create on the net profit of the company. Asian Paint's total net assets after removing accumulated depreciation is 5,851 crores. Of that, in 2019 it transferred 431 crores to the P&L account, which is 7%. Anything above 7% is a good benchmark for the depreciation rate, although it will vary with different companies and different value of assets. For example, fixed assets, which would include building, plant, machinery, motor car, motor vehicle, computer hardware, each would have a different depreciation rates, and that will affect the total depreciation that is being transferred to the P&L account. So if a company's asset base is more towards land, building, machinery, which go on for 20 years and more, then the depreciation rate would be less. But if the company is more towards asset base like computers and so on, like hardware, which has a very low shelf life, and because of which the company has to depreciate its assets at a very fast pace. For example, motor vehicle, a life of 10 years. So in that sense, it will vary. But as an industry standard, we have to understand what is the depreciation rate, and if it is falling below the average, then that's a red flag. Berger Paint's depreciation rate is 10%. Kansai's is 7%. Akzo Noble's is 12%, the highest in the group. But Shalimar Paint is depreciating its assets to the P&L account at a very low rate of 4%. That is on a net block or net assets of 217 crores. It has transferred just 8 crores to the P&L account in 2019, which is a mere 4%. Not only is the gross block and the accumulated depreciation on that very low, but even the depreciation rate being charged every year is also very low. Next, let us look at how the company's inventory has been converted into sales in 2019 as well as 3 years back. So that will give us a very good idea as to how well the company is managing to turn over its inventory into sales. Asian Paint's conversion rate of inventory into sales was around 6.7 times in a year. Berger's was 5.5 times. Kansai's was 5.6 times, and Akzo's was 7.9 times over a period of 5 years on average. And even in latest year, it was very nearby to all its averages. Shalimar Paint's turnover was very low at 4 times and 3.4 in 2019, which is again below its average. So this shows inefficiency in converting its inventory into sales. Whenever the company's inventory holding itself is very high, it basically affects the working capital requirement, as any inventory which is lying in the company is a risk in terms of reduction in price, wear and tear, loss by fire or theft, and so on. So it is better that the company converts most of its inventory into sales, or as high as possible into sales. So this concludes my analysis of these paint companies. Now let us give it a score and try to understand which of these companies have scored the highest points, and then we'll understand if we can buy into these companies using the scoring method. So I have completed giving ranking to all of these companies. Depending on how or what is the ratio of this company compared to its peer group, I have ranked them from -5 to +5. The company with the best ratios would get the highest points, and the company with the lowest ratios would get the lowest points. And after giving all the ratios their individual points, I have further grouped these different ratios into 6 metrics, which we will see later on, and we'll try to understand which of these companies have done the best. After giving scores to all of these companies, Asian Paint has got, along with Berger Paints, the highest points at 177 and 173. So these two companies have got the best points for all of these ratios combined together. Akzo Noble has got 162 and Kansai Nerolac has got 135 points. Shalimar Paints has performed the worst and has got just 4 points. So I will be leaving this ratios on for anyone who is interested in noting down these values. I'll not be again analyzing these numbers, as these are the same numbers that I've analyzed in the graphs. So I'll be leaving this screen on for 5 seconds each when we come to the metrics, and there we will look at the combined ratios. It is important to look at all of these ratios and not skip any one of them. I would highly encourage or suggest that all of you, whoever is watching this video, should look at it in its entirety and not skip any one ratio, as each ratio is very important to understand the overall health of the company. Even if we skip one of these ratios, then also it could create a problem for us in terms of doing correct investments. Okay, so now I have grouped all of these ratios into 6 different metrics. I have been in all my videos, I have analyzed all of these ratios in detail. I've explained each ratio, what it does, and as an investor, what we are supposed to understand from that ratio, or what that particular ratio helps us to understand about the health of the company. So all of these ratios have been divided into 6 categories. Efficiency metric basically involves ratios like asset turnover, which signifies how much was the sales against the assets employed into the business. Contingent liability against the net worth. What is the debt against the equity? Is the company able to cover its interest cost? The debt to profit ratio, the debtors to sales ratio, the debtor days ratio, and so on. In the cash flow, I've compared how much cash the company has received against the profit shown in the 5 years and the latest year. In the growth metrics, I have looked at the growth in sales and profits over different years. In return metrics, I have tried to understand what is the profit being generated by these companies on different variables like capital employed, equity, assets, and so on. In solvency, we are looking at promoter shareholding, any promoter pledge, the current ratios and the quick ratio. And finally, in terms of valuation, we're looking at where the price is compared to different variables like earnings, cash, free cash, book value, sales, and so on. So, according to me, efficiency metric should carry the highest weightage. It is very important to look at the efficiency of the company. Then look at the cash flow metrics as to how much of the profit is being converted into cash. Then growth metric would get the fourth weightage. So I have multiplied each of these ratios value with the weightage to get the individual score of that metric. For example, the total efficiency of Asian Paint in terms of individual ratios is 41 points total, and the weightage I've given it is 6. So 41 into 6 is 246, and 36 into 6 is 216, and so on. So this way, after concluding all of these numbers, Asian Paints has scored the highest points of 634. Berger Paints has scored 611 and second rank. Akzo Noble has scored 509 points at third rank, and Kansai Nerolac at 471 points at fourth rank. Shalimar Paints has got a negative value or negative score and is at the last. Let us look at which company's metric has scored the best. Asian Paints efficiency metric is highest, and Akzo Noble's efficiency is also very highest, along with Berger Paints and Kansai Nerolac. All are around similar 200 and above range. Cash flow is very good for Asian Paints as well as Berger Paints. Shalimar Paints cash flow is very poor, along with Kansai Nerolac. And Shalimar Paints efficiency ratio is also very poor. Growth metrics wise, Asian Paints and Berger again have done very well, and Shalimar again has scored in negative. In terms of written metrics, again Asian and Berger have scored the highest points, and Shalimar has scored the lowest at negative 30. Solvency wise, Asian Paint has got just 10 points, the lowest, along with Akzo Noble at 20. The reason why solvency is the lowest is because the promoters have pledged 12% of their shareholding, so it has got the lowest points in that sense. And even their quick and current ratios were less when we initially gave the score to these companies. Berger Paint and Kansai Nerolac had exactly the same solvency points. Valuation wise, Berger Paints and Akzo Noble have got the highest points and they are the most economical. Shalimar Paints and Kansai has got the lowest points and the most expensive and cannot be bought into at this point of time. Even Asian Paints can be considered because it has got the highest efficiency, cash flow, growth matrix, written matrix. Most of its ratios are very good. So my recommendation, if anybody is interested, would want to buy into these companies, would be Asian Paints, Berger Paints, and Akzo Noble. Even Kansai Nerolac can be considered, but the first and the second rank would go to Asian Paints and Berger Paints. If you have any comments, suggestions that I can implement in my videos, do write in the comment section and let me know. Thank you for watching this video.